Welcome to vTalkInsight, Market Drivers Daily for June 15, 2026. A tentative truce between the United States and Iran is pulling a major geopolitical tail risk out of the energy complex, just as regulators fire a warning shot at advanced AI models. Let us start with how the ceasefire and the planned reopening of the Strait of Hormuz are rippling through oil and global risk assets. The core macro story today is the interim agreement between the United States and Iran to extend a ceasefire and reopen the Strait of Hormuz, which has triggered a powerful relief rally across risk assets. Oil benchmarks have fallen roughly 4 to 6% to their lowest levels in about 3 months as traders price out the most acute supply disruption scenarios, while global equities, credit, and even sovereign bonds have all moved higher together. Compared with earlier sessions where we were dealing with rumors and a memorandum of understanding, markets are now reacting to a more concrete framework that includes ending active hostilities and lifting the naval blockade, even if many details remain unsettled. Lower crude is already reshaping leadership beneath the index level. Energy majors, such as European integrated producers and U.S. exploration aims, are under pressure after shares fell in the region of 4 to 5%, while airlines and other fuel-intensive sectors are outperforming as lower input costs support margin expectations. European manufacturing heavy markets, including Germany and the broader Euro stocks universe, are posting outsized gains of more than 1.5%, helping push the stocks Europe 600 to fresh record highs as the prospect of cheaper energy improves the regional growth narrative. The dollar has weakened against most group of 10 currencies, providing a further tailwind to emerging market foreign exchange and reinforcing the risk on tone. Beneath the initial optimism, the agreement architecture itself embeds ongoing uncertainty. The ceasefire extension is for 60 days, during which tankers are expected to transit the strait without tolls, and Iran has signaled willingness to destroy its stockpile of highly enriched uranium under a two-step verification process that would unlock phased access to frozen assets. At the same time, Israel has publicly rejected the deal and intends to continue military operations in Lebanon. Sanctions relief mechanisms remain opaque, and disagreements within the Group of Seven on enforcement and security guarantees highlight how fragile the political coalition really is. Shipping firms and insurers are therefore moving cautiously, waiting for concrete guarantees on safe passage, and there is broad recognition that even with a truce, logistical bottlenecks and damaged infrastructure mean oil and gas flows are unlikely to snap back to pre-conflict levels quickly. Structural energy risks also limit how far the risk premium can compress. Damage to key assets, such as Qatar's liquefied natural gas facilities, depleted strategic reserves that need rebuilding, and the demonstrated ability of Iran to close the strait, I will all argue for a floor under longer-dated crude expectations, even after today's pullback. For central banks, the combination of easing spot prices and lingering supply risk supports a wait-and-see stance. Markets have already priced out some previously expected rate hikes, but a sustained shock or reversal could still force a more hawkish response from the new Federal Reserve leadership. In summary, the ceasefire has removed some tail risk and unleashed a global risk-on move. Yet the path back to normal energy flows looks uneven, and that keeps scenario analysis front and center for C-suite decision-makers. Those same geopolitical currents are now colliding with the AI supercycle, where regulation rather than oil is driving volatility. The AI story today is less about exuberant growth and more about policy risk. The United States government has ordered Anthropic to restrict access to its most advanced models to U.S. nationals, forcing the company to disable those systems for foreign users and many international enterprises. This move, described within the industry as unusually severe, underlines that advanced AI is now being treated as a national security asset, and it introduces a new kind of operational risk for companies that had integrated U.S. frontier models deep into their workflows. It also accelerates data and technology fragmentation, as overseas customers reassess the reliability of U.S. platforms and look harder at open source or Chinese alternatives. Regulatory scrutiny is not limited to a single firm. Broader export controls on advanced AI models and active Group of 7 discussions about technological sovereignty signal a shift toward a more interventionist stance that could tighten rules further after upcoming elections. European and Canadian policymakers are already prioritizing domestic AI and defense technology investment over reliance on U.S. suppliers, while talk of potential government stakes in frontier labs would, if realized, fundamentally change the competitive landscape. In parallel, sector concentration has grown extreme, with AI-related stocks estimated to account for around half of the S&P 500 capital expenditure by hyperscalers and AI firms running near $800 billion this year, heightening sensitivity to any policy-induced slowdown. Despite these risks, real economy investment in AI infrastructure remains intense. Competition for data center capacity is driving enterprises to treat AI token usage as a distinct budget line, similar to cloud spending, and demand for semiconductors and memory chips tied to generative AI workloads is expected to stay strong into next year. Hardware and infrastructure providers, from traditional chip makers to downstream plays like specialists in scandium-based electronics, are seen as less exposed to model-specific regulatory shocks because their products are needed regardless of which software platforms dominate. Space is emerging as an extension of that infrastructure theme. SpaceX is investing heavily in proprietary compute, has shifted from building its own models to leasing cloud capacity, and is earning substantial fees, reportedly up to tens of billions of dollars annually, from AI firms that need additional compute and connectivity. AI is also reshaping content and media business models, offering both opportunity and controversy. Ethical consent-based AI tools are enabling legacy musicians to re-record catalogs and regain control over iconic tracks, with major publishers like BMG backing these projects. While in sports and streaming, deals such as Fox's planned acquisition of Roku highlight how data and direct-to-consumer engagement can multiply advertising revenue. These examples show that AI-driven revenues are real and broad-based, yet they arrive alongside a record pipeline of AI and space-related initial public offerings and large bond deals from giants like NVIDIA, which together raise familiar questions about whether supply of new paper is starting to chase peak demand. The key watch points now are how swiftly Anthropic addresses identified vulnerabilities, whether regulators push further on export controls at the Group of Seven meetings, and how investors respond to the coming wave of AI-linked issuance. All of this will feed directly into the broader growth story, where AI, cheaper energy, and resilient consumers are pulling in the same direction. The growth backdrop today is being driven by several reinforcing engines rather than a single story. Lower oil prices on the back of the U.S. Iran truce, ongoing AI-driven capital expenditure, and robust consumer data are combining to support a soft landing narrative, even as headline risks remain elevated. The S&P 500 has already risen about 8% this year despite repeated geopolitical shocks, and recent sessions saw one-day gains of around 1.8% for the index and 3% for the Nasdaq 100 as energy prices dropped and risk sentiment improved. Japanese and European benchmarks, including the Nikkei and the Stoxx Europe 600, are printing record highs, signaling that the growth story is broadening geographically beyond U.S. megacap technology. Under the surface, market leadership is starting to tilt away from a purely AI-dominated trade toward a more cyclically driven pattern. European equities, especially automakers and other manufacturing-heavy names, are outperforming on hopes that cheaper energy and a more growth-friendly policy stance in Brussels will translate into better earnings. Energy-sensitive sectors like airlines and chemicals are seeing improved margin expectations from lower fuel, adding to the rotation, while small and mid-cap companies are increasingly expected to contribute more to earnings growth in the second half of the year. In commodities, copper prices have climbed from roughly $2.50 to nearly $7 per pound over the past decade, and the latest easing in geopolitical risk around the Strait of Hormuz provides a constructive backdrop for demand tied to infrastructure and energy transition projects. Real economy indicators help explain why growth expectations remain firm. Spending data from major card networks show U.S. consumers still increasing outlays year on year in areas such as travel, restaurants, retail, and electronics, even after a period of elevated gasoline prices and geopolitical stress. Wage growth for lower and middle income households has accelerated from roughly 1.5% to 3.5%, narrowing income gaps and supporting continued consumption resilience. At the same time, capital markets remain open. Infrastructure-related municipal bond issuance is projected to rise, trading volumes in muni exchange-traded funds and separately managed accounts have more than doubled over 5 years, and large technology issuers from Amazon to NVIDIA are tapping global debt markets to fund AI and digital infrastructure build-outs. Monetary policy sits uneasily between these growth and inflation crosscurrents. Falling oil prices and easing inflation expectations have led markets to price out earlier assumptions of additional rate hikes, and the Federal Reserve is widely expected to hold policy steady for the remainder of the year while it evaluates incoming data. Yet strong AI-driven capital expenditure and solid labor markets could keep core inflation closer to or above 3%, and some observers warn that a renewed energy shock or an upside surprise in wages might push the new Fed chair toward a more hawkish stance than markets currently discount. Looking ahead, the balance of evidence still points to upside growth risk, but with greater dependence on stable geopolitics and continued access to capital. Earnings breadth, consumer spending trends, and the supply of new equity and debt from AI, space, and infrastructure names will be key indicators to watch as we move through the second half of the year. To wrap up, an interim U.S Iran truce and the planned reopening of the Strait of Hormuz have pulled a major tail risk out of energy markets, driving oil lower and supporting a broad risk-on rally, even as shipping bottlenecks and unresolved politics keep a residual risk premium in place. At the same time, the AI supercycle is colliding with geopolitics. Export controls on frontier models, a massive $800 billion capex wave, and a heavy pipeline of AI and space-related issuance are all reshaping how technology risk is priced. Overlaying those themes is a surprisingly resilient growth picture, with strong U.S. consumers, upgraded earnings forecasts, and renewed leadership from cyclicals, Europe, and space-linked sectors, balanced against the possibility that persistent investment and wages keep core inflation sticky. For now, markets are leaning toward a soft landing with contained energy risks and a Federal Reserve on hold, but the durability of the Iran deal, the next round of AI regulations, and the breadth of the earnings cycle remain critical watch points. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.